put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just, pick a number, but it's going to be super, super high. They don't care about the price. They want the ounces. But neither silver nor gold are as overbought as they were 3 weeks ago. So they worked off some of the overbought. The paper sales did not work in cash. I mean, yes, they got a short-term pullback. This was amazing that the metals have, they pulled back. They pulled back basically to where they should have on charts, relieved the overbought. And here we are again, not as overbought as we were before. And in silver, well, in both, in gold and silver, you're starting to see some global price insensitivity.
In today's news recap, gold price falls 3% amid market sell-off. Gold prices tumbled over 3% on Friday amid a broader market sell-off sparked by fresh remarks from U.S. Federal Reserve officials that dimmed hopes of another rate cut. The yellow metal fell to as low as $4,034.54 per ounce during the early morning trading, erasing most of its gains from the last few sessions after it looked like the metal was tracking towards its best weekly performance in a month. Driving this decline were hawkish signals given recently by Fed officials that diminish the likelihood of a December rate cut. Additional monetary easing, which the market had previously anticipated, would have bolstered the appeal of gold. Market expectations for a 25 basis point rate cut next month fell to 53% from 64% earlier this week. CME Group's FedWatch tool showed it's this idea that we're going to see a lesser likelihood of a Fed rate cut in December that is taking some of the wind out of the sails of the gold and silver market. David Meager, director of metals trading at High Ridge Futures, told Reuters, when margin calls and liquidations happen, traders close everything to free up margin. This is what partially explains why even gold is down in this risk-off environment, said F., a market analyst at City Index and Forex.com, in a note. Even with this pullback, gold is still up nearly 60% this year, with central banks stepping up their purchases for asset diversification and investors piling into the metal as a hedge against growing fiscal unease in some of the world's biggest economies. Some of the froth has been blown off in a much-needed correction, Rona O'Connell, an analyst at StoneX, said in a note. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
You're talking about the dominance of the physical market over the paper market, which has been the opposite for the past several decades. Can you explain that to people?
Yeah, I mean, the paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer, I think you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical because they have to deliver real physical that does not exist to be delivered. The market is, I mean, the bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. There's not as much concern. There's concern. I mean, if gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview and was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt, and in a place where it can't be taken from you.
In today's news recap, gold drops as Fed rate cut expectations fade. What happened in gold today? Early Asian session witnessed bullish continuation in gold, retesting $4,211. However, price failed to gain acceptance above the $4,211 high, and subsequent price action followed a gradual lower high, lower low initially, only to unleash heavy and strong one-sided sell-off that dragged the metal all the way to $4,038 as selling intensified after $4,120 to $4,110 area failed to hold as support. What is expected ahead? The next support sits at 61.8% Fibonacci retracement zone, aligned with $4,023. The rebound needs a clear break above immediate hurdle, $4,100, followed by strong break above next resistance. $4,110 to $4,120 consolidation zone. Short-term challenge is $4,185, followed by $4,215. If price retests $4,023 on the downside, this zone calls for monitoring for any reversal signs and buyer's intervention as failing to hold, as support will expose next potential zone, 78.6% Fibonacci retracement at $3,963, which is considered as discounted zone, often a strong reversal area and point of interest with the best risk versus reward. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Well, going back to visit the late 2019 episode, that was just before COVID, and the repo rates spiked to 10%, and that the Fed was having to put $100+ billion into that market every single night so it could clear. Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID, and it allowed central banks all over the world to flood the markets with liquidity. Problem solved. Not solved, but the can was kicked down the road. Here we are again. We're nowhere near where we were in October of 2019, but the overnight rates are starting to move higher again. It's a concern and should be watched. Again, everything, whether it be the real economy, production, consumption, transit, and also the financial world, the financial economy, everything runs on credit. If credit gets disrupted or credit ceases anywhere, it'll be a shock that will it'll shut the whole system down. We have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, and that lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just, pick a number, but it's going to be super, super high.
What do you think of Holter's take? Do you agree with him? Post in the comments down below your gold and silver price prediction for the end of the year and share with the stackers your strategy moving forward. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.